All right, good morning and welcome to another edition of the Main Management Weekly Market Note. This is for the holiday shortened week into June 18th. Let's get into it. As usual, our offerings, ETFs across the top there. If you're interested in learning more, go to our website. On the performance, as usual, weekly performance on the bottom there for the sectors, more up than down. I guess you call it, 6 up, 5 down. Leader was tech and industrials. Tech has seen
Yep.
massive inflows, continues to see driving the market, inflows into broadly indexed ETF products as well. Laggard was energy down 5.9. I think that doesn't feel good for anybody holding the energy sector, but the reason is the Iran kind of compromise, but now they're saying it's closed. So we're kind of back to the open again, closed
Continually
again.
chopping down. Yep.
But
Slowly and surely.
I think the longer term trend is we are moving towards a longer / more permanent reopening of the Strait of Hormuz.
Yep.
But either way, we've also seen that even when it reopens, there will be other supply lines that have been put in place in response to this. And that is going to help price stability as we go forward, where you don't have this bottleneck in one place where companies are clearly like, okay, we have to figure out different ways to be able to get oil out of there. And so they're working on that as we speak and don't want to have to rely on the Strait of Hormuz. On the broad index side, real quick, emerging markets up the most 5.9, and commodities again down the most, weighed on by energy prices. Session dashboard, no changes from last week. The big kind of, I guess policy piece here was the FOMC. This was Warsh's first meeting as Fed chair. The big surprise was basically everything was more hawkish than people had anticipated. They left the target rate unchanged at 3.5 to 3.75. But the updated dot plot on the right there, you can see now 9 members favor at least one hike this year. That's more than was it back in March's SEP. They Warsh didn't submit his dots, which was something that Powell did. But I think basically they're trying to kind of cut down on the language and the length of the statement when people were parsing the grammatical changes, like, oh, the comma was before this and that, and it's like it was very short, to the point. Notably, they didn't even mention the maximum employment side of the mandate. They mentioned and talked only about the price stability side of the dual mandate. So clearly they are focused on inflation where it stands and trying to bring it down from the accelerating levels it's at. The good news is that they were able to omit the maximum employment side because it's not, for now, the labor market is basically a non-issue. Chugging along, numbers have been better than expected. So they say, great. That is, for now, not an issue we have to worry about. We're going to focus on price. There were no dissents, so where was it? 4 dissents, I think, last time. So you're seeing the committee as a whole shifting into a little bit more hawkish mode. You saw significant upward revisions to 2026 and 2027 inflation forecasts as well on the left there. For 2026, PCE is now at 3.6 from 2.7. That's almost a full percent higher. And then core PCE is up 3.3. Forecast to be up 3.3 from 2.6, so markedly higher expectations, which means that they are on track to raise rather than lower rates. And markets are pricing in, call it 1.25 hikes, I think.
Yeah, I'll say one thing is kind of most interesting to me. Obviously, Warsh, I don't want to say ran on, but promoted this policy of being more dovish when Trump was trying to decide who to nominate next to being Fed chair. And I think that's obviously changed in the past few months. Obviously, you've had the Iran war that just spiked oil prices, part of that, but even still, he very much is not as dovish as he once seemed. Now that he's actually in the seat, and it's kind of to be seen how that looks after you get through this spike in energy prices. What he does, not just in 2026, but in 2027, 2028, and beyond. That's probably the more important part.
It's also led to some people being like, did he just play the part of the dove to get the chair? Which maybe, either way, I'm pleasantly surprised by this development. I think we here have been kind of saying, hey, they need to focus more on inflation because thankfully the labor market is solid. And it's good to see them. And I think markets also appreciated that, where, yields did lift and you had a bit of a sell-off, but realizing, hey, persistent inflation is a much larger concern for markets than slightly higher policy rates to combat that inflation. And with the policy rates, they're known, they are stated, they are forecasted. It's a different animal than inflation, where you're like, oh, it's who knows how much it's going to run.
If you look at the kind of implied Fed funds rate, or even like the 2-year yield, right after the meeting, it was up I think I want to say even if not the most, one of the most. It was up the most since any meeting basically
Yeah, like 13
ever.
bips or something
Yeah,
on a
which is
2 year.
a
Yeah,
pretty big move
yeah,
just based off of one FOMC meeting. So clearly, kind of impacted the markets there, at least on the short end of kind of what people are expecting in terms of rate hikes, rate cuts.
yeah,
But yeah, we'll wait and see what kind of happens to the longer term.
yeah. On the economic data side of things, the biggest release last week was retail sales. They posted a solid plus 0.88% month over month gain, solidly above forecast for a 0.5% increase. Core were up a little bit more muted, 0.5, while total X autos were up 0.8. So that, autos helped drive this headline number. Those are very discretionary items. You're not going to buy a car if you're feeling
Yep.
pinched. You will try to fix or continue driving the car you have. So basically, this is a very good reading for the consumer side. Yes, gas stations did drive that on a dollar basis. But again, the moral of the story here is the concern about potential slowdown in spending has largely not played out and not shown up. Energy prices are up. Yes, the decline in the savings rate is down. We've mentioned this before, but also it's worth noting, again, boomers are weighing on that savings rate as they have no income, they have no earnings, and all they're doing is spending. So that is going to be a big weight on that savings rate. So I think maybe you discount people who are out there like, oh, it's gone from 2.6 to 2.4. It might go negative. If it goes negative, it's because the boomers are spending, and you're seeing that show up here. So I think that's a big piece to remember. The data, again, you can see on the right there that year-over-year numbers, those are like straight up the page. Like those are ripping to multi-year highs on year-over-year gains. So consumers are still coming to play.
You have a lot of wealth effects there too, given where markets are and on the boomer side too, high savings historically, and then they're their stocks are at all-time highs. That makes it easier to spend.
And for those who have been in a house for 20, 30 years, your real estate assets have doubled, tripled in some places.
That's true too.
So it certainly helps your psyche out. Looking in through the numbers a little bit on the left there, we show year-over-year rankings. No surprise here, gas stations up 27% year-over-year. Again, that's because not necessarily people are buying more gallons of gas, they're paying more per gallon. Retailers, non-store retailers up the next best, up 12.2 year-over-year. Again, signs of spending across the board. Only one negative category on a year-over-year basis, and that's furniture and home furnishings. Then you can see department stores are up 1.9, the second worst. But I think no surprise, department stores are dropping just because of the shift to online spending. I don't know of any, most of the department stores I know are closing, not opening. And on the furniture and home furnishings, similar idea, but also you saw a huge spike in like COVID when people realized, oh, I'm going to be home. So I'm going to spend a lot of money on upgrading my furniture, updating my house. You saw that in building materials supplies as well. So that's kind of a little bit of a skew that's still maybe working out here. And then on the right, it's worth noting, we were talking about non-store. That's now the biggest category. It's that dark blue line. You can see it started basically when the internet was birthed in the early 90s and has slowly risen from 2.5 to now 18.3%. It's just below that COVID spike. So really, this is a big structural move. And you can see it's taken share from autos, which are now down to 16.8. Those have been up at 23, 24% of consumer spending. But I think structurally, you're seeing a shift here. For a while, they were kind of fighting back and forth. Now, non-stores really made a concerted move ahead. And then you can see clearly on the bottom right there, gas has spiked in the last couple of months. And that's pulled from autos, unsurprisingly, even though autos did help the headline number this month. And you can also see bars and restaurants have started to taper off a little bit, where people are maybe saying, hey, I'm not going to go out to eat because I just spent $100 to fill up my tank.
Yeah, it is interesting on the gas part. If you look, it is still below where it was obviously in 2022 when you had another gas price spike. And then even like 2011, 2012, 2014, it was a higher share of retail sales.
It was 10 to 12%.
Like it is today.
Yeah, now it's it's half that. So you're seeing also part of it is fuel efficiency on cars that helps you when you have to buy fewer gallons per gas on there. Shifting a little bit, another data point, the industrial production figures were out. These missed forecasts. Industrial production was up 0.14, manufacturing output inched up 0.05, slightly below forecast for a 0.5%, or no, 0.3% increase, excuse me. But again, on the right, you can see the indices in the year over year. And the monthly moves are a little muted this month, but they're up 3 out of the last 4 months. The indices are at multi-year highs. Industrial production is that dark blue line. That's back to its highest level since August of 2019. Manufacturing output is trying to break above its post-pandemic spike. It's at 98.6. That's the best since April of 2022, but they're both accelerating on a year-over-year basis. So again, the monthly numbers kind of signal through the noise, generally speaking, these are trending positively as far as the indices go. You can see on the left here, durable goods have really been driving that. A big part of it, you think about the tech spend, semiconductors, chips, that
Yeah.
stuff falls into durable goods, while non-durable goods is stuff like energy, gasoline, that sort of thing. But the durable goods index is up its highest since Jan of 2019, up 3.2 year over year. Non-durable are at 95.3 on the index level, down 0.6% year over year. And then on the right, we do delve more into, even further into that kind of industrial production, high-tech components, where the only one that kind of pulled back a little bit on a year-over-year basis is computers and peripheral equipment. But again, you can see these are all grinding higher, and that simple average that we take, that red dotted line, is up to 10.9% year-over-year. That's the best since last July, just as a simple average, showing that these things are basically all growing at double-digit rates on a year-over-year basis, which is no surprise there, given the market dynamics, AI CapEx build-out that we're seeing.
I would say like this kind of business spending, capital equipment, all of that is probably the strongest area of the economy. It's growing at the highest rate this year, obviously driven by AI, driven by broader industrial or reindustrialization. So yeah, you can clearly see that in the data.
Yeah. On the import and export prices side, this is a little more closely watched, the last couple of months here. And you can see on the left, that chart, those month over month increases, for good reason. People have been looking at these because they have just been ratcheting up after a prolonged period of kind of ebbs and flows, more down than up, treading water. Here you're seeing this concerted acceleration on a month over month basis. Import prices were up 1.9% month over month. Exports were up 1.3%. That import figure is nearly double forecast for a 1% increase. So we're getting large numbers. And again, this is, part of this is when you're importing stuff, it has to get here. The transport costs feed into this, fuel costs feed into it. But as shipping companies are paying more for fuel, they are passing these on. You think about, this isn't feed into import export prices like United and American and Delta all raising the baggage fees. It's like it costs more to get things from one place to another. They're trying to pass that cost on, and that shows up in prices. On the right, you can see the indices themselves. They've spiked pretty hard here in the last couple of months. Both of them are at all-time highs on an absolute basis. Year-over-year import prices are up 6.7 and exports up 11.2. That's the most since mid 2022 when we last had that inflation spike. And the energy spike as well. So since October 2025 alone, import prices are up 10 and exports up 7. I don't think we're seeing many, hopefully this will start to deflate a little bit here or slow down on the month over month increases as things kind of equilibrate, especially on the fuel side. But for now, these things are just up and to the right. Why, as we mentioned, the main culprits have been petroleum and tech related. Energy prices up because of the Strait of Hormuz closure. Tech prices have been bid up because demand is fast outpacing supply. And that's a very simple Econ 101. More supply, less demand, prices up. On the left, you can see the crude import prices. They're up 45% year over year. 3 months alone, since last October, they're up 47. 3 straight double-digit month-over-month increases, and the highest since July of 2022, up that 46% year-over-year. And then tech on the right is even more skewed. This does go back further, but the data looks odd. It's like inconsistent as far as the periodization is concerned. Whole point is you can see inside that blue circle, like those are tech import prices. Up and to the right, year-over-year is up 14.4. They're up 14% alone since last October. The month-over-month prices have been big. So I think there's, for this, for the time being, is we probably expect this to continue because this is kind of fuel independent almost on the AI tech demand side. Companies need this and they're willing to pay
out the nose. And a lot of this is being driven by the Mag 7 too. Paying for these elevated memory prices, chip prices. They are basically, they have to do it.
And they have, the big companies have the cash to do it. So they're saying, all right, we don't want to lose this race because we didn't want to pay more 2 months in a row for these prices that are out. And they can, kind of get a competitive advantage over the smaller companies, which are maybe a little more budget constricted. So yeah, interesting stuff there. On the Philly and New York regional Fed manufacturing indices, shifting gear kind of back to the industrial side of things. On the left, you have NY Fed, both the future and current pulled back a little bit. Philly was the second region to report. Current improved, future pulled back a little bit. But again, look at the trends here. Last couple of years, both of these choppy, but they're up and to the right, now back in positive territory, especially on the current manufacturing side. And one thing to note within the Philly, particularly Philly data, and was the CapEx, the future CapEx expenditures or capital expenditures are at their highest level since June of 2021. So again, pointing to these companies and these responses are going to continue spending.
Mm-hmm.
That is what all the data is saying, all the kind of forecasts, the views, the surveys. It's like maybe we're pulled back in the last 3 months, but our plans to do so have not shifted. If anything, they're accelerating, I think. In summary, FOMC left rates unchanged as expected. The hawkish shift in the tone was a big thing. Markets suggested it and are kind of saying, all right, now we know what we're working with. I think there was a little bit, as we mentioned, maybe a fear that Warsh should be more dovish because of his comments and kind of the process of getting to be appointed chair. But he clearly showed not an issue, willing to be hawkish what needs to be. Retail sales up solid, no signs of consumer spending weakness here. Industrial production, manufacturing output still chugging higher on a longer term basis. Again, 1 month does not a trend make. Import and export prices continue to see big price gains. And then you saw New York and Philly Fed manufacturing indices were mixed, but they continue to trend higher on a multi-year level. This week, we get the big Thursday is a big, basically only data point day. But we get core PCE, income, consumer spending, the final reading for Q1 GP, GDP, and durable goods orders. And then you do get the goods trade balance and that final Michigan sentiment reading on Friday. So maybe we see the sentiment starting to tick back up a little bit as gas prices are down.
Maybe, yeah.
But I think people are pretty angry, regardless of whether or not they have reason to be. So that's where things stand. Thanks for joining us again, and we'll talk to you next week.
Thank you.